seen the bond sell-off abate for now. Does that give you some comfort?
No, it doesn't really. Last night's price action did calm things down. We got to a level in bond yields around the world, particularly say the UK and the US, where long-term investors would say that's value. But all the reasons we got there haven't changed, and this might just be a bit of a pause that refreshes for a couple of days. We might see a little bit of a drop in yields, but ostensibly the problem remains.
Can you run us through the reasons why we saw that quite aggressive sell-off in the previous 24 hours from the UK to the US?
Look, it's been a case in markets that has been building for some time, and one where you've got some structural changes. The demand for bonds has changed. The investors who around the world would normally buy bonds are retreating to other asset classes like infrastructure or equities. You've got supply, so the governments are all having to issue a lot more debt to pay for the pandemic era borrowings and the refinancing of the debts from that time, and that's costing them a lot more money. It's a bigger interest bill for governments. You've got healthcare, a massive increase in defence spending around the world, which will be years ahead of spending. And then you've got sticky inflation. And then probably another story to throw in on all of this is this almost attack on the institutional framework of governments, central banks and their independence, which we can look back to April and look at what happened with the Trump administration at the time. More recently, looking to replace members of the US government's, or the US FOMC, the Federal Open Market Committee, the central bank. And all of that just snowballs into investors being far less comfortable owning bonds and happy to see the yields rise.
So does this talk to the sell USA trade?
It does in some ways. Everything's sold off, and because the US remains the sort of benchmark for financial markets, everything follows that, even Australia. But if you look at somewhere like the UK, that's a really interesting example of a country where a massive underspend on all parts of society for decades as they looked to reduce their own government debt and their borrowings. That's now coming home to roost. They're promising under a new government all this spending, and the income they're going to get from taxes and revenues over, say, a 30-year period just doesn't equal the cost of the money that they're going to have to borrow over that period of time. So that's one market where it's really tough. But you've seen it in Japan, you're seeing it in Australia, and you're certainly seeing it in Europe and the US.
How does the shift away from economies relying on central bank stimulus to fiscal or government stimulus as a driver of activity play into sentiment?
Yeah, look, that's a big story too. For many people who've, I guess, watched financial markets for the last 10, 15 years or almost 20 years since the GFC, which is a long time, this idea of quantitative easing, where central banks buy the government's debt, it's one part of government ostensibly lending to the other, that saw yields compressed to record low levels. And we're on the unwind of that. Central banks no longer buy bonds. In fact, it's not just that they're not buying, they're actually selling. They're trying to deflate their own balance sheets because they know that in time there'll be another crisis. There always is, but not that they're looking for one. It's just that there will be another one and they'll need to be there ready to buy bonds again. Plus, in many instances, these central banks have actually taken losses on their bond holdings, the bonds that they bought. And so they're under a bit of a pressure from the treasuries of the government they work for or work in. And that's meant that they've had to sell bonds. And so they're putting this extra supply into the market. And all of that combined with sort of structural decline in demand has just pushed yields higher. And it's meant that investors are less willing to lend to governments, particularly over longer terms, like 20, 30 years or longer. They don't really want to buy those bonds.
What does this mean for interest rates in the long term? Are they going to be higher?
The structure of interest rates will be higher. It doesn't mean a lot for mortgages in a place like Australia because we're a floating rate market. We're really only looking at the 3 to 6 month part of the curve, and that's hasn't moved as much. Yes, there was a bit of a rise yesterday in our short-term yields. That came about because the GDP numbers in part were a little stronger on the consumption side for the economy, a bit of a handover from the public sector. But for long-term money, for borrowers looking at long-term rates, they're simply higher than they've been for a long time. And in fact, if you look at, say, the UK, the long-term yields in markets are the highest they've been since the late 1990s. In the US since sort of 2011, Germany is 2008. So, and Japan is up to sort of 30 years. They've never been so high in yield. So we've definitely seen that. And the ironic part of that is most central banks, and Japan is a side on this one, most central banks are actually still cutting policy rates. Not aggressively because they're near the end of their cycles, but that should lower rates. But what we've seen is the very front end of borrowing, 1 to 2 year rates, they've come down, but all the borrowing that governments do, which is the longer tenors, that's actually gone up.
Does that impact living standards if governments are going to have to pay more to fund basic services?
In some countries it does, because they'll have part of their budget needs is to limit the amount of interest paid, or if they can't do that because of the cost of money, then they've got to try to square it up with, well, what can we cut to balance our budgets? And I think in the end, a lot of investors who lend the government's money, buy their bonds, are saying, well, I kind of need you to do something around your budget position. And in doing so, less on defence, less on social welfare, less on healthcare. Where are the bits you can trim? And this is where it actually comes to bite bigger parts of the economy. So people do lose out in this environment, and it's a tough thing to try to balance, because you simply have to pay that interest back to the market for the money you're borrowing.
Staying with financial markets, is this in part why the gold rush is on?
Yeah, I think gold is something that for most of us in financial markets, metals people aside, we've often scratched our heads at why would you buy gold. Sadly, if you've missed out this year, it's been one of the greatest trades in many decades. Gold doesn't pay an interest rate. It sits there. You can lend gold and make some money out of that, but it's pretty marginal. But what's very interesting, in the last couple of weeks, you've seen that central banks around the world have a larger proportion of their assets, which is their country's assets, in gold than they do in the other standard of financial markets, and that is US government bonds. So the percentage has changed in favour of gold. Now, there's a valuation part of that, but there's also just an absolute percentage. And what we've seen, particularly in 2025, is that there's been a rush from central banks around the world to hold more gold than ever, and in every format, through the ETF market, through physical gold holdings. And you've seen that then translate across the wider investment market down to retail investors who simply want to hold gold. If you walk up to Martin Place, there's a bullion store. There are always people lining up outside. It's a bit of a mistrust that you're seeing in fiat currencies, not necessarily the Australian dollar, certainly the US dollar to some degree, and that's fueling this demand for gold, which we've just never seen this before. Record after record high.
The bond market is often described as where the smart money is. What warning signs is it flashing for share market investors?
Well, the cost of money, has to be put into everything that we do, whether it's buying houses or valuing equities or infrastructure. And as yields rise, you need to compensate in other parts of your asset portfolio. And to your question earlier, your statement earlier around the idea of, is the structure of yields higher? Yes, it is. So you then have to build that into your valuation models for equity. So it sort of means that if yields stay where they are, long-term money costs what it does, then you need the compensation to be through the price of equities. And it should mean a weaker equity market, all things being equal, but sometimes it doesn't. And that's partly because the asset class of bonds is being shunned in favour of holding credit, which is borrowings of companies, and also equities, because simply they're not bonds, and investors want to actually chase something that is perhaps a little bit more tangible. They're not trusting governments like they used to.
So what does all this volatility mean for that traditional 40-60 bond equity portfolio construction? Does it work like it used to?
It's been about a year or so where that magic portfolio hasn't worked. Bonds have had a fairly poor return over that time. A lot of that actually over a 5-year period comes from the fact that yields were extremely low, repressed for a long time, with interest rates at zero or negative around the world. I think you had as much as 13 trillion US dollars worth of government debt being negative yielding. In other words, when you bought it, you always lost money on it. And that's flipped around. But the returns over, say, a 5-year period have really shown that as yields have risen, it's not been bonds that have performed, it's actually been equities that have performed. And part of that is things like the AI boom and some of the big tech stocks that we all know about in the US. Broader markets have also done pretty well. And I think the way portfolios are being constructed now, there's a real reluctance to put bonds at a government level into portfolios. It's been a far more comforting trade to go and buy credit, so companies' bonds.
Martin Whetton, thank you so much.
Thanks, Alicia. Bye.